Hello, everyone. Today on the final bar, my guest is Chris Brecher from Brecher Trading, coming back on the show. A lot to unpack, given everything going on right now in the United States and in the world. The market's certainly, going through all sorts of movements, plenty of volatility injected. The S&P finishing the day on the stronger side in terms of up from yesterday, but really the afternoon was about some distribution as I think everyone processed the news. We'll unpack all of that and more. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining me every weekday after the close as we attempt to unpack the activities of the day in 30 minutes. There are some days when, to be honest with you, I am looking deeply, searching for things to talk about on a day that's relatively muted. I had the opposite experience today. I was telling my guest, Chris, before the show, my cup runneth over with things to address in terms of sector movements, thematic changes, the 10-year yield getting above 1%, Bitcoin ripping to a new high. Anything else? I mean, there's a lot happening, and to say nothing of the fact that there are obviously plenty of headwinds and tailwinds going on right now. I've following on social media today, just watching how everyone's interpreting the news events going on real time as we're recording the show here just after 4 p.m. Eastern. And, some of the great comments, I think Joe Fahmy, I wanted to say on Twitter, was mentioning, there are emotional traders and there are more disciplined, calm traders, and try to be a calm trader. So as much as possible, we're going to focus on the message of the charts. I think in times of uncertainty, in times of volatility, there's no better time to focus on the message that is inherent in price. That'll tell you what you need to know about everything going on around you. We have some great guests. Chris Brecher from Brecher Trading joining us again today, which will be a lot of fun to hear his take on the S&P. Tomorrow we have Bob Lang from Explosive Options coming on the show for the first time. Next week on Tuesday the 12th, we have John Kosar from Asbury Research joining us from Chicago. John's one of the best at just thinking about the overall risk assessment, so very interesting to hear his take on the first quarter. And then Doug Bush from ChartSmarter, one of the best stock pickers that I know, coming on the show. So we have some really good guests to start off the year, giving us their take on where to be placing your bets as this year and as these days unfold. Getting to our market recap, as I mentioned, there's so much happening, and I would say on a day like this when we're really in, pun intended, uncharted territory. I've not seen the news flow that we're getting from the Capitol and all the events happening. This is a new one for me in terms of how it impacts the markets. We've certainly seen unrest, we've seen uncertainty, and we've gotten used to that. This is yet another new experience we're getting in the last 12 months. And so overall, when things like this happen, and when I'm asked, well, how is that going to impact things? In general, it's all about speculating it, but the message is there on the charts. Focus on what's working, focus on what's not working, pay attention to key levels. It doesn't matter what causes stop losses to be triggered or entry points to be reached. It's the chart that tells you what to do. So I think the fact that you're listening to the show, listening to my voice, hopefully looking at charts, I feel like you have a one-up on others that are not doing so, because it is a way to see through the noise and to see a little more clearly when it feels difficult to do so. Having said that, let's review with the message that we can get from the markets today. The S&P up over 0.5%, up more. It was up around 37.35 earlier, and ended up closing, a little above that. Ended up coming down to around 37.48, and so overall finishing the day about just over 0.5% higher. Looking at some other markets, there's the chart that's refreshed here. So up around 37.80, coming back to 37.50, just below that for the close. Mid caps and small caps, though, really accelerated out of the open. You can see the uptrend in the small cap index, at times up over 5%. Continued down to be around 4.8% or so, but certainly leading the way in small cap value out of the 9 Morningstar style boxes. Certainly the strongest. If you like volatility, a day like today certainly injects it, with the VIX reaching 26%, 26 almost. The NASDAQ was down, and technology, one of the weaker sectors at times, really sort of struggled in terms of the major market averages. Looking at some other asset classes, one of the big stories was 10-year yields accelerating to the upside. You had plenty of volatility here with the long bond futures and the bond ETFs moving to the upside. Let's go to one of the charts here just to see the 10-year yield here, because the market overview wasn't looking quite correct here. Let's see. TLT. So this is the chart of the TLT. And as you can see, when we're thinking about bonds, this is not a new phenomenon. And I've often reminded people, when you're wondering what an asset class is going to do, look at the chart and focus on the trend. So when you look at the TLT, you can see a clear pattern of lower highs and lower lows. You can see now 6-7 times over the last couple months, the TLT has attempted to breach its 50-day moving average. A declining 50-day moving average has been a 100% successful at failing at that key level. And now in the last 48 hours, really accelerating to the downside, pulling back down lower today. If we switch and look at the 10-year yield index, whoops, wrong one. Here we go. We can see how this is fluctuated around, now getting back above 1% for the first time. And in general, when you're thinking about 10-year yields, this trend line that we've talked about for a while is a key one. This is starting from the peak in 2018. This is connecting to the peak in 2019. We breached that in the fourth quarter, and now it's fair to assume that we're going to potentially see continued an up move in there. Now, what does that do? That tends to help the markets with exposure to higher rates, exposure to an increasing yield curve. And that would be things like regional banks, that would be things like financial stocks, and that's why you're seeing a lot of them show some pretty good signs of strength. Continuing on, looking at some other asset classes, gold and silver sort of struggling a bit. This is the chart of the GLD. Now, just yesterday, we had gold and precious metals rallying very nicely to resistance. I talked about the break above trendline resistance. That's a thumbs up. Silver had done so a little earlier. The GLD and gold spot is hitting the high from November. That actually seems really positive. And my comment is, if you can get above that last line, get above that last resistance, there's certainly potential for further upside. That certainly did not happen today. We're getting more of a reversion back to the downside. So back below this Fibonacci resistance level. And so at this point, the question is this a failure at resistance? Is it meeting resistance and finding a bit of a ceiling there and coming off? Or, is this just a pause before a resumption? So, the trend we had sort of seen is an improvement in commodities, an improvement in precious metals, a bit disrupted here so far today. Cryptocurrencies, however, continuing to impress. And let's finish with the chart of Bitcoin. It's a fascinating process watching this market that is essentially driven by investor behavior. If you want something that is a read on sentiment and euphoria and speculation, you'd be hard pressed to find something more perfect for that than cryptocurrencies. And Bitcoin has really seen a manifestation of all of that investor euphoria and investor psychology. Continuing to move higher today, up over 6% from yesterday. And what's interesting is I wrote an article a little while ago talking about Bitcoin 37,000. This was back here when it was breaking above 14,000, nearing the 20,000 level. And my comment was it could get to 24,000, but sort of the stretch goal would be 37,000. I did not honestly think in a month it would be reaching those levels, but we're there. And now you're seeing projections way up in the hundreds of thousands from the street and elsewhere, speculating for much further upside. In general, markets tend to, the contrarian hat that I have somewhere tucked away, and as a trend follower, I usually don't wear it, but when I put it on, I think something that has arisen, that has accelerated, you're waiting after that euphoric rise for some sort of pause and backing and filling. And I think the problem is if you are, looking for a pullback in Bitcoin, you've not really had, and that speaks to the strength of the trend. I think that speaks to the staying power of the trend. But what do you see from a technical perspective? You've seen it's becoming extremely overbought with an RSI above 80. And what that usually means is even if you get a bit of a pullback, you'll probably get at least one more push higher. And that's arguably what we're looking at now, is that continued uptrend. And the question is, when do you start to see some divergences? When do you start to see Bitcoin going higher on weaker momentum? And I would say overall, on the average things that I'm looking at, we haven't seen it quite yet. In terms of other things that are moving, and apologies for jumping around, but there's so many different themes to try to uncover here. Looking at the Dow industry groups, things that worked the most, it's renewable energy, and again, the other, I feel like it's one of the many news sort of data points we've looked at. We have the runoff elections in Georgia indicating the high potential for a Democrat-controlled Senate for the first time in a little while. And that is causing a rise in things like solar stocks, hydrogen names. That's the renewable energy group here, up over 10%. Heavy construction, that's going to be things like Caterpillar, which had a nice rise. So it's sort of these infrastructure names, it's renewable energy names. Those are the things that are working really well right about now. What's struggling, whoops, we're moving around just a bit here. What's struggling, it's things like technology, right? Struggling a little bit here. So here we're looking at the XLK down about 1.7%. And again, we talked about the weakness in the NASDAQ as sort of weighing heavy. The FANG trade overall not working today. It's a rotation into other places. What works when we're seeing rising rates, when we're seeing the speculation of improved infrastructure spending? It's financials, number one, and we'll talk about some of those charts in a bit. It's materials related to the infrastructure discussion. It's energy, looking at oil prices that are increasing and overall increasing upside there. So plenty of movements around. There's so many themes, so many ideas to try to tease around. When we get back from our break, we'll talk with Chris Brecher from Brecher Trading. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're so thankful that you're joining us every weekday after the close to review the markets together, try to make sense of things. And on a day like today, when obviously so much volatility, so much uncertainty, the message of the charts is one of the most important ones to pay attention to. So I'd encourage you, things like money management, things like risk management are not incredibly difficult. It's not the analysis that's the tough part. It's actually following what the charts are telling you. That's the number one thing. So let us help you along your journey as you're understanding your own charts, questions that come up in your normal learning process. Let us help you. Shoot us an email, thefinalbar@stockcharts.com. We'll do another mailbag segment at the end of this week, and we'd love to answer one of your questions on the air. I want to bring on my guest, Chris Brecher from Brecher Trading. Chris, coming back to the show, we mentioned beforehand, it's a nice calm day for you to choose to come back on the show. Chris, welcome back.
Yeah, thanks for having me, David.
So on a day like today, I think people are just struggling to get their head around what's going on. And what I love about starting with the 15-minute chart you and I were talking about, I love how it tries to just make sense of where things were at. Talk us through how this fits into your perspective here today.
All right. Well, I keep going on probabilities. And to me, when the SPX gets too far from its 50 simple moving average, we do them also on weeklies and all that. But intraday, when they get ridiculously far from their 15, that means to me the probability is you're not going to go up anymore, but you can't just blindly short the market, which you've seen a lot of people do. I then go to a shorter term chart. And when you see the shorter term chart, you can see a mile away, like on a 3-minute, the trend line, which is pretty exciting. And I got short there. A lot of my clients got short because you were trying to combine 3 reasons. So the 3 reasons I had were the 15-minute chart was too far from the 50, and you had some negative divergence. But then that trend line on the 3-minute was just beautiful.
Yeah, so, you mentioned, Chris, the 3-minute chart and that bearish divergence. Here we're looking at the 3-minute chart, and we see the uptrend here, and then the MACD at the bottom, right?
Right, or the 15-minute.
Yep.
But the biggest warning sign to me was how stretched intraday the 15-minute SPX was. And usually then the probability is I either look for a reversal candlestick, I look for the trend line, or I look for stocks that didn't participate on the way up. And those would be my first priority on the way down. And that's the way I try to trade.
So coming off of a day like today, Chris, how are you thinking about tomorrow, right? You mentioned, the things that did not participate. Where are you looking for opportunities right now, given obviously unprecedented uncertainty, volatility, and a quick reversal midday here? Where are you looking for opportunities now?
That's a good question. Number one, I guess we have to worry about what's going on with any kind of geopolitical situation in Washington, not just the vote, but other stuff going on. The second that got on TV, that's when we went down. So I have to see how that rectifies itself. On the other hand, like the chart I showed you, the 15-minute now is at the 50, but the weekly is still ridiculously extended. So on the SPX, so everybody always talks about what do you mean by extended? And I try to quantify it. And to me, when you look at a weekly, the SPX right now is about 500 points away from the 50 moving average. And now I know when it's higher, you have to look at percentages, but still that's pretty high. That's well over 10%. And that just to me is a warning sign that either you have tighter stops or you look for reversal candlesticks to trade intraday. Or you do a more of a swing trade if you see a massive reversal on, let's say, a daily chart. The problem is, and you'll see it, it looks like a blip today. It doesn't look like a thing. The NASDAQ does, the SPX doesn't look like anything.
It's interesting on the weekly chart,
means,
Chris, you're illustrating on this example. I mean, I think, implying the relationship of how far the S&P is from the long-term moving average now versus sort of early 2020 versus early 2018. Are you seeing that sort of similar potential for downside, or how would you sort of gauge where we go from here in the first quarter?
Well, the first thing is this bond sell-off is going to start making a difference, I think. And the bond sell-off isn't because they're going for stocks. It's because inflation is starting to spike.
Yeah.
And that could put the Fed in a tough spot. So it would be an excuse for this to start reverting back to the 50 on a weekly. It doesn't have to go really straight down like the other times, but it more stutters. So it can have the 50 try to catch up. But definitely this is a really dangerous situation in here. The sell-off in the bonds was great for banks. That's why the ES, I think, stayed up 26. The sell-off in the bonds, it was a rotation into the Caterpillars of the world. And I think if bonds stay down, the ZB or the TLT, you'll see the TLT looks like it broke down. That's going to eventually compete for your money. So, I mean, if you have, if that TLT goes down about another 7 points, then all of a sudden, instead of saying there's nowhere else to put your money, all of a sudden there is. So there's a certain point where if the TLT goes down enough, I think the ES does start to revert to that 50. And like you said a million times, a lot of times the market needs an excuse for where it goes. And they might say instability, but you use the charts and it's like, hey, they're extended. It's about time it has a rest.
Chris, this is fantastic. I really appreciate you coming on and sharing how you're thinking of a day like today. I think our viewers have a lot to learn from people like you to try and make sense of things. Chris Brecher from Brecher Trading, thanks as always for coming on. We'll talk to you again soon.
All right, take care.
That's Chris Brecher from Brecher Trading. Chris does a great job of just trying to put things in context. I love talking with people who have a calm sense of, just trying to look at things and trying to understand the relationships. He's hit on something I haven't talked about a ton, which is just how extended the market is from some of the long-term moving averages. It's actually a really interesting point. And I've related where we're at right now to early 2018, sort of late 2017 in terms of the breadth thrust, in terms of some of the accelerations, the sentiment levels. But it's interesting to think of it in terms of rotation, sort of a mean reversion play coming off of those highs. That's a really great take from Chris. We need to move on. Our next segment is called "It's All Relative." I was talking before the show and just trying to think of ways to approach what we're seeing today. And in a day like this, in a stretch like this, and even up until today, right, in the last year when we've been dealing with so much uncertainty, the question is, where do you go, right? Where do you sort of focus your time and your capital? And in general, I think it's about leaning into what's working and leaning away from what's not working. And there will not be a time on this planet, or certainly when I have a microphone in a show, where I will not tell you to, follow good trends and lean away from bad trends. Right? Lean into what's working, lean away from what's not working. And even if you're able to just do that consistently, I think overall you're going to be in pretty good shape. So the question always comes back to, well, what's working, right? Where are the trends and where are they at? So, just thinking through some of the movements that we've seen, some of the groups that are working and some of the groups that are not. When I think about what's working, and what you can do is just look at ETFs that were up pretty good today. Where were people rotating based on their expectations of what's to come next? It's hard to look better than things like regional banks, the KRE, the KBE. These are ETFs that track the financial sector, particular parts of it. And when you have a situation where the yield curve is getting steeper, which means the spread from the short ends of the long term is getting wider, meaning if that's your business to play that curve, then it's going to get better. It's going to get easier for you to do business if your business is lending and things like that. And so regional banks certainly getting a vote to the upside on the sell-off in bonds and the upswing in the 10-year, because the lower end of the curve is still very, very low. So the steeper that gets, the better, the higher interest rates go. You're going to see the financial sector do very well, which it certainly did today. You're going to see regional banks continue to do well. When you see that big uptick in small caps and mid caps, I think years ago and early in my career, sort of oversimplified and would think of small caps as a thing and large caps as a thing and the technology sector as a thing. And what I've learned later as my career has gone on is that they're all overlapping, right? So when you think about the small cap index doing so well, it's because if you look at the mid cap index and the small cap index, it's a bunch of financials. It's a huge part of those benchmarks, much more than the S&P 500, where the financial sector is less than things like technology and consumer spaces. So when financials are going to do well, that's going to make small caps and mid caps look a lot better than you might expect, just because of that. And other sectors that are overrepresented in the large cap index are underrepresented basically in small cap. So there are a lot of different things at play here, and certainly you're seeing some relative gains there. Again, my comment on something like regional banks working today is hopefully this is not the day when you realize regional banks are working. Hopefully it's back here when we talked about the financial sector hitting the June peak and breaking above it and not looking back. It's when the financial sector, the XLF, breaks above its 200-day moving average and tests it, and the KRE continues to resolve to the upside. It's when you consistently see a pattern of higher highs and higher lows, and on pullbacks, it doesn't get below the previous swing low. That is the sign of a healthy uptrend. And the fact that the relative strength line has improved so much. If you look at the relative strength in regional banks, really through the end of the third quarter of last year, it wasn't that impressive. It was continuing, making new relative lows there the third week in September. And then look at how that completely reversed. And some point between that moment, between October 1st and today on January 6th of the next year, hopefully you recognize that relative strength, saw the improvement that we've noticed in the chart. In my opinion, this is not the way that something tends to end. This tends to be more of an indication of a further impulse to the upside. It's overbought. I don't have a problem with that. I think that recognizes the upswing, the push to new highs. It's all about what happens on the next pullback. And if you continue to make higher lows on something like the regional bank ETF, I think you're in pretty good shape. Here's the XLF, just so you can see. Very similar chart, a little different in terms of the specific turning points, but overall the trend has been the same. We've talked about the performance in the financial sector, certainly breaking out to the upside, and there's certainly potential for that to continue higher. When we talk about relative strength, I immediately think of the Scooter rankings. That's really designed to help you focus on the strongest pockets within the long-term trends. Really, it's leaning more toward the long-term trend characteristics. Tesla has been the number one stock, 99.9th percentile of the Scooter large cap rankings. You can see another nice update, up almost 3% today. And so overall, again, it should not be a surprise that Tesla is working. The trend has been in place for quite a while, and the goal is to identify when things are breaking out, to recognize that we're making higher highs and higher lows. So continuing to make new highs should be just sort of business as usual. As we talked about, my concern, or the red flag, the warning sign I would be looking for is when you start to get bearish divergences. Arguably you had one here in mid-December when you had higher highs in Tesla, lower peaks in the RSI. that's been negated, right? I mean, it's now broken out of that divergence. I don't think that's no longer, excuse me, I don't think that's valid anymore. I think what we're seeing with continued strength is that there's further upside in the space, and I would continue to be leaning into some of those areas that have been working. Semiconductors are an interesting one. We've talked about this a lot of times as, something I see as a bellwether group. I would say I could see a scenario where stocks start to struggle, and the question is, where do people go? Chris Brecher's comment was, people go into things like bonds, which are, arguably, now starting to yield a recognizable amount, a non-zero amount. But the fact that yields are going higher, interest rates increasing, means all of a sudden, income yielding stocks less attractive the higher that those go. But overall, something like semiconductors could certainly be seen as a safe haven. When things start to struggle, you could see people going into sort of the comfort blanket, the security blanket of something like semiconductors, something like technology, the XOK. But what we've not seen is those sectors working and that group working today. Today was certainly a rotation into some of these other areas and away from technology. And, when you look at the XLK going down, remember, that is not just one thing. It's made up of a bunch of things. So you need to look at the FANG stocks as a group. The New York FANG Plus Index down almost 3% today. So the average FANG stock not doing great. If you ask where you do see a bearish divergence, I would argue with the FANG chart, you're actually seeing that, right? So higher highs in price, lower peaks in the RSI. Now, totally fair. This is what happened to Tesla in mid-December, and it resolved to the upside. So if you see that same negation, if you see this resolve to the upside, I will make the same noise about the FANG trade starting to work again. But it's certainly indicating further rotation away from the FANG stocks, away from large cap growth into small cap value, and small cap certainly working today. Value stocks working today. And let's finish with the materials sector. Again, in general, if you're struggling with how to make sense of this, I would look at what's working and look at what's not, and lean into what's working and lean away from what's not. The materials sector has been improving on a relative basis. We noted the improvement in the relative strength over time. It's sort of stabilized for a while, and what we're doing now is making a new 12-month relative high. We'd had this peak in September, and since then, on a relative basis, sort of mid-range, sort of keeping pace with the market. That's changed in the last week or two. Really going into year end, you can see how the relative strength has turned higher and now making a new high for the last 12 months. As the XLB making a new 52-week high, up 4% today. So what overall are we seeing? We're seeing higher rates. We're seeing a steeper yield curve. We're seeing improvement in financials, continued improvement in energy. These are sectors that had been working, took a bit of a pause, and now resuming their uptrend. Materials also participating in that. So it's that sort of MEI trade, materials, energy, industrials would be the last one I should probably talk about. And Caterpillar, you're seeing up almost 6%. Sorry, that's John Deere up 6%. Caterpillar up 5.5%. So these sort of infrastructure groups are doing well. PAVE would be another one. That's an infrastructure ETF. There are a couple that focus particularly on this area. You can see all of them having a really good day, really with the implication of a Democrat-controlled Congress, and certainly the clear indication that infrastructure spending is going to be a relative high priority. That is our recap of the It's All Relative. So much happening, and we'll all process what we've seen today and try to make more sense of it. We need to wrap the show, go to the 3 and 3. It's going to be about the 3 and 30 seconds, but here we go. Chart number 1 is the Treasury curve. This is the 10-year yield minus the 2-year yield. We talked about the 10-year yield itself. This is looking at the shape of the yield curve. This is showing you the steepness or the steepening in the yield curve, indicating really a tailwind for regional banks. That gets us to chart number 2, the regional bank index, up almost 8% today, having a nice run. Again, this is not new. The uptrend, hopefully you've recognized before now. This is just a continuation of that trend that we've seen so far. And finally, in general, look at the returns today and sort them from strongest to weakest. Lean into things that are working overall on the long term, and that's where the scooter rankings can come into play. PAVE is one of the infrastructure ETFs that make a lot of sense. I remember talking with Larry Berman last year about infrastructure. Certainly playing out very, very well. Folks, that is our show. Thanks so much to Chris Brecher from Brecher Trading joining us again, giving his take on the broad environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey,
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.